Good morning to our audience from the UK and Europe, and good afternoon to the ones who are joining us from Asia and the Middle East. My name is Yuvendra Hora, and I'm the head of the Global Indian Business at Barclays Private Bank in the Middle East. We have an excellent lineup today with our colleagues and partners joining us from the UK. I'm pleased to welcome you all to this third and final session of the Global India series. Before we make a start, on behalf of Barclays and BCD, I would like to express our deepest sympathies to the ones who've been affected by the pandemic globally. I hope you and your families are safe and in good health. UK property market is a topic that has been discussed frequently, especially amongst global Indian families. Many questions are raised on timing, location, the type of property. Is this the right opportunity? Is sterling at the right price? Can I get a mortgage? And many other questions that we receive on a daily basis. So we thought of putting this panel together and discussing in detail based on the expertise of the panel, and hopefully you'll get answers to some of these questions. We're joined here by Tom Bill, who's the head of UK residential research at Knight Frank. Ben Pocock joins us from the Barclays in UK, where he heads debt structuring team in the private bank. Camilla Dell, managing partner at Blackbrick Property Solutions in London. Stephen Murokorian, head of product and proposition at Barclays Private Bank in London. And Shamini Berman, director at Barclays Private Bank in the UK and a senior private banker. Without any further delay, let's get this discussion started with Tom. Tom, the UK property market is breaking records. And at the moment, in terms of activity levels that we have seen, how long can this go on, and what are the risks associated to this?
Thank you, Yuvendra, and thank you very much for the kind invitation to speak to you today. I think at the moment, if you're looking at a chart of what's going on in the UK property market, it all looks a little bit dramatic. But I think what we need to remember is that we're looking at the market currently through the lens of a stamp duty holiday that is almost a year old. So what that's done is to squeeze transaction activity into unnaturally short periods of time as people have tried to beat various tax deadlines. So we had an original stamp duty deadline, or a holiday deadline was the end of March. And so we saw transactions spike in March. It didn't happen at the end of March. It was delayed, but people still transacted. And then transactions fell quite sharply in April. So I think there has to be a recognition that things are not really very normal at the moment. I liken it to looking at the market in one of those mirrors you see at the fun fair. You can sort of make out the broad shape of the market, but you can't see any meaningful detail. So the key question I think to ask is, would the market have been as strong without the stamp duty holiday? And I think probably the answer is it wouldn't have been as strong without the holiday, but I think we would have still been talking about a market that has defied expectations over the last 12 months. The market was in recovery mode in the first 2 months of 2020, following the general election in December 2019. 5 or 6 years had passed with Brexit uncertainty, and the market had become subdued. And we were just starting to see it take off when COVID-19 came along. The market then knocked down. We then had people reassessing their homes and how they lived. And so we saw that that demand, that activity became amplified. And on top of all of that, we've had a stamp duty holiday. So it's, at the moment, I would say the market is very busy. It's probably in some cases busy to the point of putting people off and thinking, well, I'm just going to wait until things calm down and the tax deadlines pass. And hopefully from the 1st of July, I think we'll see new people come back into the market. And the other final point just to make actually is the supply and demand imbalance that is also a feature of the market that has been responsible for the double-digit price inflation that we've seen. So we saw supply didn't really pick up in the way it normally does after Christmas. There were concerns around new variants. People were homeschooling and weren't able to list their properties. People thought they'd missed the stamp duty holiday deadline. And so all of that has combined to throw supply and demand out of balance slightly. And so what we'll see, the first half of this year is not really going to look like the second half of the year. The second half of the year should be more, in inverted commas, normal. Things are going to calm down. Supply and demand is going to become more in balance. But I still think it's going to be a strong market, just one that's going to look a bit more like a normal seasonal market.
That's brilliant. Well, happy to hear that things are going to pick up, and of course, the insights that you've given us on the stamp tax holiday and so on. Stephen, if I may ask you, what are your clients doing, and what sort of transactions is Barclays Private Bank supporting at the moment?
Really interesting question. Our client strategies have actually stayed very consistent through the last 12, 18 months. We'll probably expect those to stay the same over the next 12 to 24 months also. So yeah, our clients are really looking to do three things. The first is acquire property, so a transaction purchase in the marketplace. That's been very focused around the UK domestic market. Over the first 12 months of COVID, as Tom says, people rethinking the way that they live, but we see the balance of that shifting into international markets as the lockdown journey eases. So that's kind of strategy number one. Strategy number two, it's quite an interesting one in that it relates to trading up and looking at the property that you've got, thinking about the trading window that you're in the cycle, and looking for a better location or a better footprint to your property. But what's interesting, and I'm sure my colleagues and partners on the call today would have some views on this, but we're seeing what I would call this kind of co-residential strategy. So instead of disposing of the property to buy a new one, we're actually holding on to that and buying something different. And something different is typically looking like not another London property, but perhaps a property outside of London, or even outside of the UK, to pursue a lifestyle alternative. So that's very interesting, because that has a knock-on effect to things like funding. It has a knock-on effect to things like supply and demand. So all of those characteristics are beginning to play out, and I think it's quite an interesting characteristic that's in the marketplace at the moment, certainly seeing our clients looking at that strategy. And then the last strategy really is around diversification, and that's we've got record low interest rates, we've got very good long-term fixed rates in the marketplace, and so that makes people think about how they can sweat an asset harder, take value out of that asset and convert that value into something else. It could be an investment, it could be another property, again, a lifestyle purchase outside of the UK or somewhere else in the UK. All sorts of reasons that we're seeing for that to happen. And again, the moment feels right because of where interest rates are at the moment.
I think the key, some of the points that you mentioned are really, really interesting, because nowadays we hear a lot of our clients and people we interact with discussing this entire sort of, trading up situation, the town to countryside sort of movement and so on. So we'll come to that point a little later. Camilla, how has London property market changed over the years in terms of who is buying and where? Because you've been in the market for long enough, and you could really feel the pulse of the property market, and we work closely together. So obviously, your insights on this will be extremely valuable.
Thank you so much, Yuvendra, and thank you for having me on your panel today. It would be wrong to think that all of the activity that we've seen since the pandemic started has been outside of London. There's a lot of talk about sort of rush to the countryside and everybody leaving cities like London and New York. But actually, London has been pretty active. I think what's been very interesting about the London market is who's been buying and where they've been buying over the sort of last 12 to 15 months. In a normal year, we would tend to see around 60% of our client base coming from overseas in a normal year. And that picture has completely reversed due to the pandemic, as you might expect. Probably around 80% of our clients over the last 12 to 15 months have actually been British clients, domestic clients. And they have been making big lifestyle changes because we've all been spending so much time at home, working from home, educating our children at home. We've seen a real shift towards what I like to call the prime domestic markets. So areas like Kensington, Chelsea, St John's Wood have done very, very, very well, particularly the house market. The trend amongst buyers has been a move absolutely towards houses with gardens that are close to a really good local high street and close to a park and green spaces. Those priorities have completely overtaken the old priorities, which was often proximity to a good tube station, how easy is it to get to work. That's dropped right down the list of buyers' priorities. And so the more prime central London markets like Mayfair and Belgravia and also Knightsbridge, particularly for flats, have been much more subdued, far less activity happening in those markets. Having said that, it would be wrong to think that international buyers have played no part in the London market over the last 12 to 15 months. We have actually completed on several transactions this year for overseas clients, some of whom were very, very keen to get their transactions done before April the 1st, which is when stamp duty unfortunately went up for overseas buyers. So we did see a little bit of a flurry of activity then, and clients that were sufficiently motivated to come over, do their quarantine in order to make their transactions happen.
Wow, sounds like you've had a great year. Which is always a good thing. And with the overseas buyers coming in, I guess things will obviously accelerate a little bit more from what you're saying. Shamini, I understand there's been an uptake of demand from global Indian clients coming through for residency in the UK, a topic which has been discussed a lot more in the recent past than we've heard from the years that we've been doing this. Why is it that, and what effect has or will it have on the property market, and especially in the high-end residential space?
Hi, Yuvendra. So yes, absolutely. I think the UK and in particular London has always been desirable amongst the Indian families. And given obviously the stringent regulations in India, there's always been a desire for one member of the family to live outside the UK. I think with the pandemic, it's been an additional push factor to get, and people actually had time to sit down, pause and reevaluate and think. So they put these plans into motion, and we've helped a number of families with banking solutions related to relocating. And I think the obvious next step is to have a comfortable family home in the UK, be it London or on the outskirts, depending on the family's requirements and schooling. So we definitely think this is a positive influence in the resi space in London and in the UK.
Right. On that same note, in terms of sort of inquiries, but also in terms of deals, in terms of client uptake and so on, what sort of accelerations have you seen in the recent past? So for instance, in the last 18 months, have you actually really seen like the inquiries and all sort of double, triple, quadruple? What's your sense on that?
I would say it's definitely, if you had to put a number to it, it's definitely tripled. And that's largely in the ultra high net worth space. And there was a range of families, or one family member that actually got stuck in the UK because of the travel restrictions. And given the visa limits the number of days you can spend here, that's been an automatic trigger factor for them to get permanent sort of residency here, so they can spend more time in the UK without the day count restriction based on obviously the visa. And so, we've helped a number of clients with their banking needs and worked closely with a number of law firms as well on this.
That's excellent. Well, it's really good to know. Ben, so we've been speaking a lot about commercial real estate, and most of our discussions with clients are commercial is a no-go. But I know that you've been very busy. So tell us, has COVID changed the office landscape forever? And how will this impact the office real estate market?
Morning, Yuvendra. Yeah, I believe it has changed it forever, but to the extent I think the jury's still out. Many blue chip corporates, and ourselves at Barclays are included in that, were fairly quick to announce, whole-scale reviews of their global footprint, their global real estate portfolio. And of course, no doubt they are ongoing and probably will continue for a number of years. But certainly in recent weeks, I think there's been a little bit more dampened rhetoric around the initial response. Certainly ourselves, we're obviously in the full throes of finalising plans around returning to the office. But it will be a different normality, and I think that's here to stay. We've all been working from home in some guise over the last 18 months, irrespective of location, and that really reflects, I think, probably an acceleration of what would have been the case in any event. So it's accelerated a kind of evolving workplace, and I think that trend will continue. And I think it's probably reflective of other asset classes in the real estate sector as well. It is centered around well-being and family life, and rightly so, but let's not kid ourselves. Corporates can probably extract considerable fixed cost savings. If I take an example of whether I'm sat in Mayfair at a desk, well, that desk is costing a corporate, £100 per square foot. So whilst it suits the employee, there are certain benefits for the corporate as well. So, we've gone through this forced experiment. People can demonstrate productivity remains high if working from home, IT can cope, but obviously it doesn't solve the cultural and often the loneliness that some people have felt. But I do think the longer term, I suppose, ramifications of this are the days of massive single office, single tenant footprints in London are probably behind us. I think we will move to a more flexible floor plate, shorter lease commitments, so similar to a continental model, to be honest. In terms of actual statistics and volumes, well, I think it's been a case of it will be two halves, much like the residential space. The activity now will pick up in terms of the city and the West End, and that just reflects the fact that supply was very short in the first half of the year. There hasn't been the same stamp duty kind of cliff edge that's applicable for the residential side of life. So it is picking up, but I do think there will be long-term consequences. And as I say, I think it's probably a case that corporates will spend similar money than they had to in previous years, but I think they will want a better quality product, a much varied product. If you're going to call your people into the office, you're really going to want to make that space worthwhile coming to.
That's absolutely right. Recently, a dear client of mine told me that as long as kids are going to school, people will keep going to the offices. So it's obviously, it's sort of quite related as well, and quite specific to the UK. Stephen, if I may loop you in right now, whilst there's always, seem to be new developments popping up, what's the supply situation of stock in the marketplace? And you're very close to the marketplace, so can you share some views on that?
Yes, of course. I've got some, I guess, my views from our particular position in the market, and I think they'll probably dovetail with some of the things that we're hearing, and some very interesting views already. So I think there's four things going on. I think the first is clearly during the COVID window, builders put their tools down, right? And that was absolutely the right thing to do in that particular moment. The government worked very quickly to try and bring all of that activity back into the marketplace, and I think we can remember those moments, certainly here in the UK, where that sort of that kind of building throng started again. And I think what that's also put is a bit of stress on that particular labour force, because people are upgrading their homes at the same time. So that, by definition, has had a knock-on effect. And there is a supply problem where it comes to actually getting work done on your homes, or getting the right amount of attention in terms of development. So all of that is having a knock-on effect, but I suspect that is a delay rather than a reduction in stock. So all of that will start coming back to the market, and again, that's something that will drive, certainly, I think, international buyers back into the marketplace, but also UK domestic buyers out of London. So that's kind of the first thing. I think the second thing is around that buy and hold strategy. If you own a prime property in London and you're buying a prime property in prime coastal or prime country, and you're holding on to both of those, by definition, you're not releasing something back into the marketplace. So there's a lot of that going on as well. And we perceive that to keep happening for at least the next 12 to 24 months. And the third bit is just the general market activity that we've all spoken about, as everybody sort of gets up off their chair to find a new chair, and everybody walks around. There's going to be a lack of supply, and I think I'm sure Camilla will have some stories around off-market transactions and how some of those things are happening outside of the visible view. And I guess they're the transactions that we see where somebody's buying off a neighbour or a friend or a family member or something like it's property that never really came to the marketplace. And I guess the last bit is more of a macro statement rather than an observation of what's happening at the moment. But this is very important for the UK. There are two really important things that people forget about the UK fundamentally in the property market, which is there is a distinct lack of supply of housing stock, and I'm talking nationwide at every level, and that's something that's been prevalent for a very long time. We just aren't building enough homes in this country fast enough to meet the supply. The second bit is population spike, and we're in the once in a generation population spike in the UK, which started at the end of the global financial crisis around 2014. That particular population is working its way through the system and is actually having a lot of impact on things like education. So your points around schooling are actually very, very relevant at this particular moment in time. They will continue to be relevant for probably the next 10 years. And again, schools being one of those location drivers, both as a second home. If I've got somebody, if I'm living and working abroad, but I'm trying to put my children in a school locally in the UK, I need a property to be able to facilitate that in many instances, and we see a lot of that. Or actually, I'm moving my family to a different school, and again, the property location becomes really critical and really key, because of course, timing and location and journey times, etc., just fundamental. So yes, to answer your question, Yuvendra, they're the sort of four things we're seeing at the moment.
From what you're saying, clearly the supply situation will continue to remain a little bit stressed, which most likely could lead to sort of some form of spike in prices. Having said that, we cannot forget the international buyers. So, Tom, when international flights resume, will it be business as usual for international buyers in prime central London? What's your view on that?
I think in some ways yes, and in some ways no. I think to answer the first part, I think London hasn't lost any of its inherent appeal, I think, over the course of the pandemic. If anything, the sort of relatively successful vaccination program in the UK has probably burnished its credentials slightly. I think from a international buyer's perspective, though, there are lots of things to weigh up. They're going to come back into the market, and it might be that tastes have changed slightly over the course of the lockdown. Certainly in the short term, there may be people are looking for more space in the same way as they've done here. That might produce slightly sort of more erratic patterns of transactions across prime central London. But I think there's a danger of trying to read too much into what are effectively short-term trends, and it's happened a lot over the course of the pandemic. People haven't really thought through where these things are going to land in 12 months. And I don't sense that there's going to be any fundamental shift in terms of the types of property that people are looking for, the reasons that people are coming into London. And we've seen it play out slightly in the rental market, actually. Rental values have fallen quite sharply over the last 12 months. And what that's done is brought people back into prime central London. So people that can perhaps couldn't have afforded renting in PCL 12, 24 months ago now can. And they are doing so, and for all the obvious reasons for living, there are for living in central London. So I think the fundamentals are still going to hold true. The other 2 points that I suppose to consider are, one, it's already been mentioned, the extra 2% stamp duty surcharge for overseas buyers. I think, understandably, that's probably going to form part of the negotiations. We haven't seen a lot of overseas buyers at the moment in the market, so it hasn't really been put to the test, I don't think, properly yet. But I'm sure it'll form part of conversations. But I think, on the other hand, on the other side of that argument, there needs to be a recognition that actually, in the absence of international buyers, prices haven't done very much over the last sort of 9 months. After falling initially falling at the start of the pandemic, prices have been fairly flat, and that's because there haven't been as international buyers there. We're seeing a sort of very small, modest return to annual price growth now in PCL. So things are sort of on a slow recovery anyway, in the absence of large numbers of international buyers. So it's not a very clear-cut picture, I think. It's not a case of just coming back into London and saying, right, okay, let's go and find a bargain. The market's done relatively well, I would say, without the international buyer. And the last thing, probably just to mention, is currency. That currency discount that there's been since the referendum, that's beginning to close. So the start of or the end of last year, you were probably looking at a discount of around sort of 20-25% for a range of overseas currencies compared to before the referendum. That's based on how far house prices have fallen and how far the pound had fallen. That's beginning to narrow. So it's probably now something like 15-16%. And I think that story will continue over the course of this year as the vaccine, rollout continues. The UK economy starts to recover. If inflation continues and persists longer than the Bank of England think, then they'll have to raise interest rates. Interest rates will push sterling up further. So I think what there is a slow story of the currency discount narrowing, as well as a sort of shifting tax landscape for overseas buyers. So there's a lot to think about, I'd say, when they come back into the market.
Absolutely. Camilla, since starting BlackBrick in 2007, what have you learned about global Indian buyers? How do they differ from, the other buyers in the market?
Thank you, Yuvendra. I think one of the absolute joys of my job has been meeting clients from all over the world. And I've been fortunate enough to travel to India on several occasions to meet with clients from all over India, ranging from tech and business entrepreneurs in Bangalore and Goa, through to entrepreneurs working in real estate in cities like Delhi, and even Bollywood actors. I've seen it all. I've also had a very active NRI client base in Dubai, and also in Africa, in countries like Nigeria and Kenya. I think one common theme that many of my Indian clients share is the value that they place on family. Unlike other clients, with many of my Indian clients, often the entire family will be involved in the decision-making process on what property eventually gets bought, and down to every last detail, and every single family member is copied in on all emails, and that's quite unusual. It makes searching sometimes quite challenging because everybody will always have an opinion, and sometimes it's quite difficult to work out who might be the decision maker in a family dynamic. But it's also one of the lovely things, I think, about working with Indian families is the value that they place on family. I think one of the other things I've learned huge amounts from my Indian clients is Vastu Shastra, and in particular, the importance of which way the front door faces. With clients that are into Vastu, the front door has to face north, ideally, and that's for energy, happiness, and good luck. And that makes many searches quite challenging, particularly for clients that are wanting to buy apartments and not houses. However, having said that, we have successfully managed to find several apartments for clients where Vastu is a very important aspect. One of the ways in which we've been successful for clients that are into Vastu is actually by purchasing properties that are off plan. And by doing that, we can sometimes negotiate with the developer to alter floor plans, alter layouts, so they meet our clients' very specific Vastu requirements. I remember in particular one client that I looked after, we acquired 2 properties for them, 2 apartments opposite one another. And then we actually acquired the hallway in between the 2 apartments. And then we replaced the front door in the hallway so it faced north. And that was just an amazing transaction to be involved with. Really opened my eyes to Vastu Shastra.
You know, it's very interesting. As you were telling me this, I was about to tell you an anecdote about one of my clients who bought a property while he was traveling in Dubai. And he had the same issue. The door was facing south. So he had the entire property reconstructed to make sure the door faces north. And that was a lot of money spent. But you're absolutely right. It's these nuances and your experience of working with global Indian clients that makes sure that, you know, we don't need to reconstruct things. In terms of family value, I totally agree. I mean, buying a property, and we work with a lot of Indian families, buying a property is like a decision which the entire family makes together. And everyone is encouraged to sort of shed their views, because eventually all of them have to live together. So it's such a great sort of experience. It's a journey that they enjoy a lot. And you're absolutely right. That sort of sometimes make it difficult, but it's important because they get the right property then. Camilla, tell me, are there good opportunities or bargains to be had in London now? And where do you see the biggest opportunities? And I ask you this question because this is exactly the kind of question that a global Indian client would ask us.
Absolutely. I think all of our clients that are buying property in London, particularly for investment, you know, they want a good deal. They want to feel like they're buying at the right moment of the cycle to take advantage of the upside that hopefully is coming. And I think there absolutely are opportunities to be had in prime central London at the moment. I think particularly for investors, so the whole buyer priority and the trends that we're seeing at the moment, which is creating very heated markets, goes out the window. If it's purely about investment, it's about, you know, where are the deals to be had. Where we're seeing the biggest opportunity at the moment is absolutely for flats, as you might expect, particularly flats, apartments that don't have any outside space and that are located in the city centre. So areas like Mayfair in Belgravia. Mayfair, I know, is very, very popular with NRI clients, but also out in parts of East London, in the city, particularly for new builds. Those particular assets, as you might expect, have not done very well as a result of the pandemic because of these shifting buyer priorities that we've seen. Therefore, I absolutely think that that is a buying opportunity at the moment. Some of the best deals that we have concluded over the last 12 months for clients have been exactly that property type. We actually recently looked after an NRI client from Dubai who wanted to purchase a very specific property. It had to be new build, it had to be in Mayfair or Belgravia, he had to have air conditioning, and he wanted a bargain. And because of these shifting buyer priorities, we identified an apartment and ended up acquiring that apartment for 21% less than the original asking price. It had been reduced, and we were buying it right in the middle of the pandemic, where really nobody else would be interested in a 2-bedroom apartment in the middle of town without a balcony. And so we took advantage of that. Having said that, I think this window of opportunity, it's not going to last forever. Certainly, I'm not the only person to have discovered this potential opportunity. You know, there are very active investors at the moment looking at this. And I also think once international travel restrictions ease, you know, that we will see a lot more activity in some of these areas and some of these property types. I think if I was asked, you know, how long do I think that window may last? Maybe 6 to 12 months. A lot of that does depend on how quickly travel restrictions lift. Obviously, a lot of my NRI clients at the moment are just simply unable to come to the UK because they're not going to quarantine in government hotels. I think the other really interesting thing, just to finish on, is, you know, what the future holds for prime central London. Very, very positive. I think Tom may have something to say on this, but Knight Frank are forecasting 25% growth across prime central London over the course of the next 5 years. And I think that's a really compelling reason to look at London at the moment.
It's fantastic. Look, I'm going to jump from residential to commercial. I'd like to ask this question to Ben. Ben, what does the future hold for retail assets? Could you tell us what Barclays' commercial lending capabilities are, and how are we helping our clients? Perhaps some examples, if you can share with us.
Yeah, sure. I mean, I think the structural challenges that were there to be seen before COVID pandemic have only been accelerated and exacerbated by COVID-19. Ultimately, up and down the UK, many high streets are just not fit for purpose. There is way too many units, and there is just insufficient demand. So they are going to have to reposition themselves, and I suspect residential will form the majority of that component. So central government has its role to play here. At the moment, it's certainly not a level playing field. You've got business rates that really are prohibitive in terms of new startups, people coming into the high street. And at the same time, you have a somewhat more lax tax system with internet retailers. So what you've seen with the demise of retail, so to speak, is obviously the positive aspect from logistics and warehousing on the other side of the fence. You've seen tenant situations that involve CVAs, some of the most high profile, Debenhams, Topshop, etc. And that's left big voids where there is not really replicable retailers ready to fill that space. You've got Primark, but actually beyond that, there isn't really anybody knocking on the door to take that quantum of space, that bigger unit. So again, you come back to, is it fit for purpose? Yields, I think at the prime end, so Oxford Street, Bond Street, are relatively stable, but you are really now going out towards double-digit yields for secondary, tertiary locations and shopping centres. And so I think probably from an institutional perspective, we see more downside risk than one of stability. Having said that, we do carry out transactions, even though our appetite is perhaps more limited, very much so in the non-recourse space. So we would only be looking at very tempered leverage levels in that sphere. We are fortunate enough in the private bank that we can look at things a little bit more holistically. So where we have recourse back to the UBO, the clients, the family office behind the real estate itself, it gives us a lot more optionality and flexibility. And a couple of those transactions we're looking at the moment, they're portfolios of real estate in the retail sector, which we wouldn't typically finance on a non-recourse basis, but we can come up with something that works for us and works for the client when that personal recourse is involved as well.
Thanks very much, Ben, for that. And Shamini, now that Ben has told us about commercial real estate and what we do for our clients in Barclays Private Bank on a commercial space, I was wondering if you could tell us a little bit about Barclays Private Bank capabilities for mortgages in the UK for residential.
Sure, Yuvendra. So obviously, being a British private bank with the international lens, we have a very robust mortgage offering. So we can break it down into both owner-occupied as well as residential investment mortgage capabilities. And in the owner-occupied space, we offer both regulated as well as unregulated mortgages. I would say in terms of LTVs and pricing, Barclays remains extremely competitive, and we're keen to write credit. The one thing which I would bring back to the international client base, and particularly the global Indians, during our affordability calculations and during our credit risk assessments, we often take into consideration the worldwide asset and worldwide income base, offering a very private bank lens to these clients with obviously an international asset base. And we also understand the restrictions for certain resident Indian families, and we do have policies within the regulation that help cater to their requirements when it comes to the inability to provide personal recourse because of the local Indian regulations. So all in all, I would say very well-rounded in the mortgage space in the residential side and
Excellent. Thank you, Shamini. I think you're absolutely right. I mean, being a British bank, an international bank, we've always been approached particularly for mortgages as well. And we've been very competitive with our clients. And I think as the international travel opens, I'm sure that you'll be busy as ever. Shamini, I'd like to ask one more question. So we touched upon, the move to countryside, right? I mean, that's pretty much the trend for some time during the pandemic. Have you seen, that move even from a global Indian perspective for the ultra high net worth clients?
Sure, Yuvendra, absolutely. And this, I would say the focus for this is more the families already based in the UK. And I think, as Camilla rightly pointed out earlier, that Mayfair, in terms of the apartments, the outdoor space is fairly limited. And I think this trend I started seeing in March of last year, and inquiries for mortgages from a number of families, because I think with the hybrid working and dynamic working, they very much realized that the family would be better off with the space and the outdoor space the countryside has to offer. I would definitely say the Indians only wanted to be an hour out of London in case they had to come in for any engagements over here. And we had about 5 financing queries, which turned into kind of mortgages for our clients based in the UK, all in the countryside. So and that theme is still going on and on. So clients are still, inquiring about this. Obviously, with travel restrictions, it's more the clients who are already in the UK, because most of our clients, Indians, they like to view the property, they like the wider family to see the property, but it's a great getaway without all the restrictions and all the PCR tests required to travel. So I think it's a great outlet for some of our clients, and we will continue to see the trend. But I would definitely reiterate that it's just an additional home in the UK as opposed to the primary residence. So Mayfair still obviously remains hot amongst the Indian client base, and so it's about having a pied à terre in London and much wider space outside of London.
Stephen, staying on this same subject, we hear a lot about this, like the town to country move, right? So from your perspective, and I do value your expertise a lot in this space, would you be able to shed some more light on this, to tell us what's going on?
I think that you've heard a number of views already, and they're reassuringly consistent. But the moving to the country is a global aspiration, right? Regardless of where you are in the world, whether it's Africa, Asia, Russia, France, the United States, having a property outside of the city has always been one of those marks of aspiration and achievement. And I think that will continue to be a consistent theme, for the long-term future, I imagine. In the UK, we've got some great we've got some great countryside, right? We've got some great locations that have picturesque locations, many of which is protected long term. We've got some great coastal locations, and all of that is kind of having its time in the sun. What's really interesting, and in fact, we've been doing some work on this very recently, is kind of overlaying that map of the UK with various other factors that we think are interesting. Some of those you've heard already, and they include items like access to education, a reasonable journey to a major city or London, access to high performance technology, typically centered around university towns, and various other cuisine, arts, culture, etc. Once you sort of overlay all of those things, you sort of find 5 or 6 locations that really stand out as being key, and many of those are unsurprising, but they are dotted along the kind of the southwest coast, and they're also dotted around that commuter or longer term commuter belt around big cities like Cambridge, Bath, Bristol, Edinburgh, etc. So all of that is really interesting, because at the end of the day, we're talking about human emotional decisions about where you want to live. To turn it into a kind of formula, it can be a bit too much. But it gives us an understanding as to what those possible drivers could look like for our clients. And as Shamini said, as a British bank, we've got nationwide footprint. We've got clients based all over the country. And of course, you know, we appeal to those demands today. So the good news is for global Indians that are looking to tap into that understanding and to tapping into that sort of cultural sensitivity that we understand, it's a great time to do it. And I think those towns and smaller cities, or the orbit locations around those cities around the UK in terms of that country market, I think the story for those will develop, you know, hugely over the next few years. And what's critical there will be items like government funding, will be items like some of the infrastructure that's being built in terms of whether that's HS2 or other transport initiatives that will come up in a post-pandemic environment. So all of that is a watching brief, and I think for investors it's also very interesting because we've seen nearly double-digit growth in those country markets. Is that sustainable? Is that long-term? Either way, it's happening at the moment, and there's a distinct lack of stock there as well.
It's lovely to hear. I mean, you know, for us, it's important to see from the ground in the UK. Despite foreign travel restricted, despite foreign buyers not getting in, there's still so much activity going on. And it's really lovely to see that. Tom, if I may rope you in now, just to kind of give us some insight on the London property market, whether it's, because, you know, when you read the headlines and all that, you know, it says, you know, it's the property market in London has suffered due to growing demand for space and greenery, right? So tell us from the ground, from, you know, your research perspective, because, you know, for us, that will be the real news, right?
Thanks, Yuvendra. Yes, I think, the headlines, as you say, do sort of paint a fairly black and white story, but I think there's a danger, again, of reading too much into that. Relative to how the markets in the country have performed, yes, London hasn't performed as well, but it's still had a good 12 months, given everything that's gone on. So it's all relative, isn't it? I think at the moment, the story is all about the country markets. It's having its place in the sun, as Stephen said, that perhaps in a way that it didn't after the global financial crisis, when obviously money sort of came into London, and it's a recovery that's being led by regional markets around the UK, which is fairly unique as far as I can remember. Normally these things emanate outwards from central London, so it's an unusual set of circumstances. I think that initial burst of exuberance that we saw in terms of people needing more space, that probably peaked last summer. So we track where our London-based buyers are looking. And if you go back to last summer, that's when we saw a spike of people looking in the southwest of the country, in the sorts of places that I'm sure you've all read about, such as the Cotswolds and those sorts of places. But actually, we looked across the UK, it was probably more widespread than most people realised. So places like Yorkshire, East Anglia, where people perhaps had, you know, family ties. People weren't just going for sort of greenery and the sort of postcards, you know, picture postcard properties. So there was a sort of fairly widespread sort of impulse out of London. But London's had a good year, as I say, and I think it's something that's happening in the country, probably because prices didn't do what they did in London, and it looks relatively good value. But I think, again, looking longer term, I think you have to question how fundamental any shift is going to be. I mean, we've said, you know, people have been coming to London for centuries. Isn't just a recent phenomenon that's going to turn around on the back of a pandemic. And I think, you know, there just has to be an appreciation that, you know, when London starts to look good value, and Camilla's touched on it, there are pockets of London that I'm talking to some of our agents who are saying, you know, prices have not sold in this street for this price in 10 years. There is some real good value. It'll draw people back in. And I suppose the final point I'd make is that, it was mentioned earlier, an acceleration of pre-existing trends. So people were already going out of London for all sorts of different reasons. Main one being affordability. Affordability is something we talked about a lot before the pandemic, and how it was shaping demand across London. It was sort of pushing people out of London, and it's something I'm sure we're going to be talking a lot more about again once the pandemic dies down. So it will benefit secondary regional UK markets, areas like the Midlands where you obviously have a lot of logistics space. It's going to benefit from e-commerce. It's going to benefit from the car, the switch to electric car manufacturing. It's very strong in terms of academia. HS2. There's all sorts of reasons actually why there's certain markets outside of London are going to have it's going to be quite an interesting story, I would say, in some of those property markets. We have Goldman Sachs moving to Birmingham, a fairly symbolic move. So I think again, I would keep an eye on some of those secondary UK markets in terms of sort of potential price growth. In terms of the escape to the country story, I think it's evolving. I think people are still looking for more space, but I think it probably has more of an urban flavour than it did at the kind of the height of the boom last summer.
Brilliant. So from what I can gather from the panel, sterling is fairly low. There is a lot of domestic demand. Supply is pretty sort of resilient in terms of what there is in the market. So from the looks of it, this is the right time to start looking at your first, second, or third property in the UK. Ben, touching up upon a topic which relates to commercial real estate, which a lot of our clients and people we engage with have been talking about, is student accommodation, right? So there's been a lot of factors that influence that. Now, in your view, in your expertise, could you tell us, does this still have strong fundamentals?
In one word, absolutely. And I know that the Indian audience are very keen on the sector, and that is obviously a derivation of probably what they've sampled, or through their children have sampled themselves. It is often an asset class that is coveted after the initial residential purchase. I think the difficulty with the asset class is until you build scale, it can be quite operationally challenging, and the differential between gross to net is often quite significant. But ultimately, yes, I mean, international students still covet the UK for its educational facilities. They obviously need a place to live. In terms of the domestic demand, well, part of the whole experience as a student is moving away from home, living on your own. And what I would say is, when I went to university, you were winning if you had an ensuite. I think these days that would be considered an absolute prerequisite. And instead now we're talking about the requirement for 5G, for a gym, for recreation, all those things. And so absolutely the asset class has moved on. There are slight imbalances on occasion between supply and demand in certain regional cities, but fundamentally, the asset class remains strong. Applications are up from non-EU countries by 17%. Domestic demand is up 8% year on year. We've obviously had a fall off from the EU applicants, but the forecasts are suggesting that actually non-EU will overtake that, and absolutely, from a perspective of probably this time last year, where you were at 50% occupancy because of lockdown, because of restrictions, you're now north of 80%. And all indications are that the restrictions will pretty much ease by September in total. So, understandably a challenge in 12 to 18 months, but I personally have no concerns over the longevity of that asset class. And, it is probably now considered an institutional asset class rather than an alternative.
Wow. I'd like to turn back 30 years and go back to one of these student accommodations, right? Look, thank you very much. I want to keep asking questions, but I've just looked at the clock and I think we're running out of time. I'd like now to turn to the audience and address some of their queries now.